All righty. And with that, welcome everyone. Thank you for attending our Retirement Rescue webinar. My name is Steve Wildman, and my role here at Diversified is Vice President of Planning. And I had the pleasure of working with the advisors here at Diversified to help our clients achieve lifelong wealth. Diversified is a nationally recognized, recently named top 20 RIA registered investment advisor in the nation, specializing in a various array of financial planning services such as retirement, investment management, estate tax, business planning, charitable gift planning, etc., just to name a few. We're proud to work together in partnership with all of our clients and help them achieve, like I said before, lifelong wealth. So I understand we have a number of clients here who are actually in attendance on this call, this webinar. First of all, I want to say we sincerely thank you for your continued trust and partnership during your financial journey. And for those who are not yet officially partnered with Diversified, we hope to welcome you in some point in the near future to the family. So it's with my pleasure today to host our session here with our very own Christian Foster. Christian is a senior wealth advisor here at Diversified, who in partnership with another one of our senior wealth advisors leads our Birmingham, Alabama office. So Christian has a wide array of topics to discuss here today. Retirement rescue is a pretty broad topic, but Christian has identified a handful of specific topics within the retirement spectrum that he's going to walk through with us today. So before I give a little bit of background into Christian, I encourage you all to ask questions during this session. And like I mentioned earlier, you can ask a question using the Q&A function at the bottom of your Zoom screen, which is hopefully there. So I'd also encourage those who already have an existing relationship with us and may have additional questions to reach out to your diversified advisor to talk more about those questions. And would also encourage those without a current advisor relationship with us to reach out to Christian or myself after the presentation to schedule some one-on-one time and introductory phone call. So with that, Christian, let me introduce you, my friend. So Christian joined Diversified back in 2023, and he brings over 15 years of experience as a business owner and as a financial advisor. A graduate of the University of Alabama, Roll Tide, as a Penn State graduate, it pains me to say that this time of year, with honors in finance and German, and also Christian has his CFP. He's passionate about helping his clients achieve security, balance, and peace of mind through personalized financial planning. Outside of work, Christian enjoys golf. We'll see how good he is, and also spending time with his wife, Mary Elizabeth, and their lovely dog, Love. So with that, Christian,
That's it.
To you, my friend.
Thank you very much. I really am honored to be here. Thank you for the introduction, Steve. I can tell you that I have a very special job, a job that I love dearly. It is a technical but deeply personal industry they work in. And it's one of the only things where I've ever been invited to weddings, funerals, graduations, birthdays. I often like to say that personal finance is 80% behavior, 20% finance. This is a very relational business. It is a deeply technical at times, but also deeply personal business. So like with all things, that ongoing partnership that you have with your advisor, as Steve mentioned, there are a few clients. I can't see everyone that's on the call right now, but if you are a client that's on this call, thank you so much. A lot of these topics will be a little redundant, absolutely, because you went through the detailed planning process that we take all of our clients through at Diversified. So my strongest encouragement would be if there are material changes in your life, if there is something that's bothering you, something you're very happy about, something that you want to talk to your advisor, just call. You know, I prefer call, email, or text, or whatever it is. That's why we're here. We at Diversified are here to be a CFO of your lives. So we're the chief financial officer of your lives, and you're in charge. But for us to work together, that communication is absolutely critical. Steve mentioned a little bit about Diversified, and I'll say a little bit more about our firm because I do love our firm and the way that we do things. I like this to be a very boutique, personal experience for everyone. At times could even feel like a mom and pop shop because we care, and we really do. We are not a small firm. We manage over $2 billion of our clients' money. We're one of the largest RIAs, registered investment advisory firms in the nation, one of the fastest growing. We have all of the practice areas of financial planning that are absolutely crucial. We have a lot of support in. We have a great chief investment officer, Mike Horwath, that is a CFA, which is the bellwether designation in our industry. Our advisors are CFP, Certified Financial Planners, which is the bellwether designation in our industry for planning. Mike has an investment counsel. We have retirement planning counsel in our firm. We have the tax team. Diversified Tax does an excellent job. I'm not a huge fan of attorneys, admittedly, but we have the best estate planning attorney I've ever worked with. A really pleasant, fastidious man that is very detailed, and he does a great job. Insurance, it goes on and on. So, like I said, we're not a small firm, though we want you to know that if you're already a client here, you know that we're here for you, and that we value those personal relationships. So, I'll talk my way through our whole presentation here if we don't get started. So, all right. I don't know if I'd say rescue necessarily. I didn't do this slide. If you need rescuing, we don't want to ever throw a buoy out to anyone. The whole point of financial planning is that we have some clarity of purpose, and more than anything, that we have peace of mind. That I think a lot of times, innately, we wake up in the morning and we feel that everything is going the way that we want it to go, that our retirement's great, our career's great, or whatever the various things that we have that feeling, or conversely, that we have this innate feeling that things are horrible, that I'm not going to be able to retire on time, that I'm not going to have the money I need, that I'm not going to get the things that I've worked my whole life for. So one of the most valuable things that we give to people is peace of mind and clarity of purpose. So in this webinar, we're going to touch really quickly on ways to maximize income, manage withdrawals, optimize tax efficiency, and navigate healthcare costs. I can't begin to tell you how in-depth every topic in financial planning is. When you go through the CFP process, you have about 8 large textbooks of 800 pages plus that cover all these different practice areas. And that's just to take the test for the CFP, right? So all of this knowledge that we have, we're not going to get into the ins and outs of every IRS tax code today. Thank God for me and for you guys. But we are going to touch on the things that matter most in retirement. So financial planning doesn't end at retirement. Does the market stop at retirement? Do your taxes stop at retirement? Do life events stop at retirement? Here in Birmingham, we'll see a lot of clients that come in between the ages of 50 to 70. And some people come in and it's 2 years before retirement. It's a year before retirement. Some people are 10 or 15 years before retirement. Some people have already retired and things were going really well, but they still don't have the confidence of that comes from the experience of retiring people well every week, every month, every year at Diversified. You could spend years learning the things that our advisors know, but until you've had the experience of retiring people and dealing with whatever the ups and downs and the climate is in our country and everything else, you're not going to have that confidence to know that you've retired well, that you've covered all your bases. We do. This is what we do for a living. So longevity risk and inflation is key challenges. Longevity risk is very simple. Are you going to outlive your life savings? What a horrible idea. What a great fear that we all would have, that we would outlive our life savings. So we plan all of our retirement plans at Diversified out to age 95, unless you convey to me that you know that everyone in your family has a heart attack by 80 or some other genetic issue or what have you. We run all of our plans out to 95. So there's a 30-year window where you have to have money to sustain you. And I don't think that any of us want to rely on Social Security alone. I mean, that's not going to cut it. So longevity risk is the risk that you'll outlive your money. Inflation. I mean, has anyone bought milk this year? Did anyone buy milk 5 years ago? Gasoline, used cars. I like to think of inflation, what I tell my clients often is that think of your retirement money, the principal, as a large pile of sand in your front yard, right? Just this huge pile of sand. Inflation is rainfall. It's just the rain. It's yearly. Some years are worse than others. But that torrential rainfall slowly erodes and washes away all the principal of your life savings. And if we don't add sand back in via equity was the best way, or tips, which were treasury inflation, anything that protects against inflation, we have to have growth. So sand has to be added away to keep that eroding power of inflation away. So that's obviously a pretty simple analogy. The importance of working with an advisor to create a tailored plan. I don't think that, I really think this is self-explanatory. Each and every one of us have different fears. We're motivated by 1,000 different fears in our life. Each of us have different goals. Each of us have different dreams. Do you want to buy a Ferrari every 5 years? Would you like a retirement home in another state or on the beach? Do you have legacy bequests to charities? Do you want to start endow a scholarship? The reason that you need tailored advice is because every human being is different and we're motivated in different ways. The one common thing that we might have is money, but that's where it stops, right? This, and again, I don't want to digress too much because I want to make it through. And Steve, you just, yell at me here if I get too far off topic. But when I wanted to get results in the gym, right? When I wanted to have a healthy diet, I downloaded different diet plans. I looked different workouts up. I tried to eat healthy. I joined a gym and never got the results I want, right? Because I looked up generic things. The second that I started working with somebody that was a personal trainer that tailored my plan to me, to my bad, knee, to my bad shoulder, to my diet proclivities, all the different things that go on, then things really started to come together. So I think that's pretty self-explanatory why a tailored plan for you is for you. Building and managing retirement income streams, Social Security optimization, claiming strategies, including spousal benefits and delayed credits. This is one of the first questions, most commonly asked questions that I have, that we have in our practice is, when do I take Social Security? So if you were born before 1960, then your retirement, your full benefit is going to be between 66 and 67 years old. After 1960, it's 67 years old right now. You can begin taking early retirement and Social Security at age 62. But for every year that you do that, there's a permanent 5% reduction in your benefit amount, your lifetime benefit amount. So obviously 62 to 67 being the full retirement age, whatever year you decide to take it, that 5%, whatever the years remaining are, you can do the easy math there and deduct the 5% a year. Conversely, again, if you wait until age 70, so you can take it from 67 up to through age 70, you get an 8% year benefit in your primary insurance amount. On a personal note, so we'll have obviously some people need money now, some people don't need it now, again, tailored to you. On a personal note about spousal benefits, my mom and dad at Thanksgiving were talking about their benefits, and I took a look at what my mom and my father had, and I realized that my mother's spousal benefit wasn't 50% of my father's, and hasn't been for the last 5 years because Social Security has got it wrong. So now we're in the process of going through, and she's going to end up getting some back money, but her benefit's going to be increased because they didn't have the right numbers, right? So a lot of people don't think to question these things. These are situations that come up. Delayed credits, obviously, if I didn't mention that before, is just that waiting until age 70. Pensions and annuity, evaluating pensions and annuities, especially in the Northeast and from wherever everybody is here, in union strong places, pensions are much more common. They're still really common in the South too, with big long-term businesses. Pensions are excellent, but should you take a lump sum pension? Right? Should you take a payout that has survivorship? Should you take the highest payout now? There's a lot of different layers to pensions. And again, that's an income source that we look at. All of our planning really starts with, and if some of you guys are Dave's clients, and you probably have heard this before, but it's what do you have? What do you make? What do you owe? What do you spend? Those are these questions that we answer for clients. And it's not sexy or fun, but basically it starts with cash flow, right? How much are we spending? What income do we have flowing in addition to Social Security, in addition to your withdrawal strategy, in addition to a possible pension? Annuities, same thing. I think Steve is probably my best resource on being an annuity guru, but you could have immediate annuities, fixed index, deferred annuities, variable annuities. You can have different riders, ceiling floors. One of the things that I'll say about that is that I just described a lot of different products. And I want you to understand that there might be a case where an annuity is great for you guys. But many years ago, I was a stockbroker at a very reputable, large national firm. And what I did is I sold things, right? I sold equities and bonds and tips, and I did financial planning, and I thought that I did a really good job, but I wasn't a CFP then, and I wasn't a fiduciary. It was a much lower standard for people that often call themselves financial advisors, that are bankers that need to sell a proprietary product like a CD, or insurance guys that need to sell a VA because they get a really large payout, or whatever the case may be. We don't do that. We do not have a product that we sell you. What we do is take a holistic approach to your planning. So while I got off on this topic because it mentions annuities here, that's very personal to you. There's that might work for some people and it might not. Generating investment income from retirement accounts and other investments, that's just standard, right? We want our money to work for us. So what's the rate of return that we're getting on fixed income portions in your account? What are the CDs in your account paying you? What's the dividend yield on the equity side of your portfolio? Is that in a qualified account? Is that in an after-tax account? Are you going to pay capital gains or phantom taxes on these things? These are all different areas of financial planning that we can talk in depth about. So again, very broad overview here today. The safe withdrawal rate, creating a sustainable withdrawal plan. The 4% rule. Well, the 4% rule is a rule of thumb that's been in the industry. It actually comes from a study done in 1998, the Trinity study, that posits if you have a 3 to 4% withdrawal rate, there's a 98 to 100% chance of the time in equity dominated portfolios that you will not outlive your money or that your plan will be successful. Now, that could mean you have $1 left on the positive side at the end of the plan. And it also has to be heavily equity dominated to continue that growth, but it does work, right? The 4%, we know that 4% withdrawal rate is a rule of thumb that people have used for a long time, and it's been very successful. And that's why everyone knows about the Trinity study and that 4% withdrawal rate. So tax efficient withdrawals, I think I just kind of covered that there. Strategies by account type. Again, we have a progression of how we liquidate funds, right? If we go through your after-tax accounts, your retirement accounts, your qualified accounts, you will pay income tax on all those dollars. Finally, those tax-free accounts and the Roth, which I hope everybody is taking advantage of a Roth that can. Amazing accounts that give us there's nothing better than free money. And essentially that's one of the few times that we ever get growth like that, and the government gives us the ability to have that. So that's the tax efficient withdrawals. It depends on your income bracket. It depends on the tailored plan that we have for you. Is your income going to be higher in retirement? Is it going to go down? Do you have vesting stock options that might take another 10 years? Do you have an inherited IRA that from a parent or a loved one that has a 10-year rule that you have to get the money out? So everyone has a little bit different income situation, and that's how we would decide where to have the withdrawal from. Sequencing withdrawals. Again, this goes into what I was just talking about, and I'll say this as well. One of the things that we talk to our clients most about down here, and that people don't really think about often, is your sequence of withdrawals risk or your sequence of returns risk in your portfolio. Every year that you take 4% down from your portfolio, you're taking it in up years and you're taking it in down years. If you have $1 million portfolio and you take a 20% hit one year, and then that's $800,000 left, and you're taking 4% from that portfolio, that's another 40,000. So you're down to 760,000 from where you started. The market can't just come back next year with 20% to get you back to where you started. Capital preservation is one of those things that we shoot for because we want that pile to go down slowly. So when we have big withdrawals, when we have big return years that are negative or positive, all of these factors obviously are going to change your plan and how you take your money. So things that I talk about with my clients on a regular basis. Let's see. Oh, healthcare and long-term care planning. So Medicare overview. This is going to be very simple because this is also, we can get into so much about this. And I just encourage you guys to reach out. Please reach out to me. Medicare Parts A and B are traditional Medicare. A doesn't cost you anything. That's your hospital insurance. B is going to be your physician coverage plan, and some others. There's a premium associated. C is going to be where private industry has come in and works with Medicare to offer the Medicare Advantage. So that's going to cover it's going to cover A, B, C, dental, vision, and D would be prescription costs. But again, that can be part of your Medicare Advantage plan. There are things that also go into that healthcare planning. How much are you budgeting for healthcare costs? Are you looking at how much those premiums are going to be? Are you familiar with the income, the IRMA bracket that you're in? And I've been working with a client that's doesn't want her premiums to go up, that there's a 2-year look back on the income you brought in to tell you what your premiums are going to be for healthcare now. So again, a lot of different details. Long-term care insurance, pros, cons, and when it makes sense. I mean, you're going to have to call me. You're going to have to call me. Long-term care, if you have a deep sense that you are going to have some kind of genetic issue or family problem, and you're young and healthy, long-term care could often make sense from a price standpoint, from a premium standpoint. Cons with long-term care are if you've had any kind of health issue, if you're older, your premium is going to go through the roof. Another con with long-term care, again, it's very expensive, which is wonderful. But with long-term care is that as a class, as part of a long-term care class, we see clients that get increases all the time. All right. There's nothing you can do because they can't target you specifically, but they can increase the entire class. And then all of a sudden you're paying more out of pocket and it's very expensive. I just got a 5-minute warning, so I'll speed up a little bit. Healthcare savings strategies. Please have an HSA. If you are in a high deductible plan, please take advantage of an HSA. There's an $8,300 contribution limit for families, but that money never runs out, right? There's no income limit associated with it. In 35 years, if I have receipts and I had a surgery and I've kept up with my medical expenses, I could use my money 35 years from now in my HSA to pay today's medical expenses. Tax-free. It is an amazing benefit, and I really encourage Roth and HSAs. I really encourage everyone to take advantage of those. So, well, here we go. Tax planning and retirement. Again, another great topic. Minimizing your R&D impact, required minimum distribution strategies. Again, this goes back to what's your tax situation, right? So you have to take RMDs at 73. One of the greatest things about a Roth is that there aren't RMDs required. So that RMD strategy kind of goes back to what's your tax bracket, who are you, and what do you want your money to do for you? Roth conversions, another great thing that we can have. That depends on if you believe that you're in a fairly low income tax bracket now, and your conversion, and we expect that you might have higher income later in life, that we want to go ahead and pay the taxes now on these qualified dollars and convert them to a Roth so we can have it tax-free later. That's very individual as well. And so that's one that we look at often. And strangely enough, often Roth conversions don't make sense to people that really feel like they would have, which I can tell you all about. Again, if you reach out. Tax loss harvesting, this is another easy one. When we go in, we're going to have individual positions inside of your portfolio, which would be your equity tax loss harvesting. But again, that goes into your bigger picture. Are you a business owner? How are you filing your taxes? What are you expensing? Are you doing itemized deductions? Are you taking standard deductions? All of these things are very pertinent to the suggestions that we made for you. Let's see. Inflation proofing your retirement, strategies to combat inflation, tips. We can buy, this is a Treasury inflation protected security. We buy these through Treasury Direct, directly from the federal government, if it makes sense, inside of a portfolio. This is a unique fixed income investment. They come out in 5, 10, and 30-year terms, in that the principal amount, so the money that you bought initially, if it's $1,000 bond or $1,000 tip, if inflation increases that year, they actually change the principal amount that you get back at maturity. And on the other side of it, it will decrease as well if inflation is lower according to CPI than the standard. But most fixed income investments pay you a coupon payment. You're not going to receive a regular coupon payment from these. You're going to get an adjustment in principal. Best thing to combat inflation, the reason that 4% Trinity study works, is equities. We got to grow. We want to go up with the market. We want to take advantage. You can't do that with fixed income. Now, we can get into the nuance of that, but without a doubt, no one's going to disagree that equities are the best way for you to combat inflation. Adjusting withdrawals for inflation, I think I've kind of really touched on a lot on why withdrawals are important and what the market adjustments are. Cost of living adjustments, like your Social Security, we're going to get COLA adjustments. There are definitely pensions that give those. There are definitely annuities that get those. And again, they'll if that makes sense for us and that's right, then we'll employ one of those products, and then that way we can have that cost of living adjustment to combat inflation. Let's see. Planning for legacy and estate transfer. Am I out of time? I might be. So
Thank you. Finish up.
So let me just say this really quickly. I guess you guys can tell I do enjoy what I do. We use trusts all the time. We want to avoid probate. Trusts have gotten to a point where I think, well, I know 20 years ago, people who used trusts, it was very expensive, and it's such a commonplace legal document now, and it's so beneficial. Trusts avoid probate, obviously, but they make sure that your legacy bequests go exactly where you intended, and they can't be, a will can obviously be contested in court. A trust, that's not the case with trust. We also get some asset protection from creditors if it's an irrevocable gift, and we can get in more on why trusts are great. Beneficiary designations, another great way to avoid probate. Do we have a pay on death? Do we have TODs? Do we have your 401k? Are your beneficiaries, are they accurate? We had a client that had an X on his 401k that had been on there for 20 years, even though he was remarried and hadn't changed it. Had no idea. He thought he had changed it. So beneficiary designation is very important. Tax efficient transfers. I would love it if every one of you had to worry about the estate tax laws, because that's $27.98 million exclusion that all of us have. So if you get over $29 million and we're worried about the taxes associated with that, we've had some very notable cases in our firm where that was the case. We will bring the full weight to bear of all the resources we have to make sure that there's going to be a litany of issues at $28 million that we are going to have to work on with you. And then you're going to get that upstream family office that we would have to provide. So defining legacy goals, again, this goes back into why trust is so beneficial. Or unfortunately, a lot of time people these days have family members or loved ones that have maybe addiction problems or maybe healthcare issues or special needs trusts. Trusts are an excellent, and they're very much tailored to you. How'd I do? There we go. Thank you guys so much. I probably took a little extra time than I should have, but it was been my honor. So
yeah, thank you, Christian. So in the interest of time, we have time for one question. So I'll just reiterate, for those who are already working with your diversified advisor and you have additional questions, please follow up with him or her. For those that do not have a relationship with Diversified as of yet, feel free to reach out to Christian, and you can use this QR code right here on the screen. So, but in the interest of time, we do have one question, Christian, that came in, and it goes like this. Christian, with Alabama being ranked number 11, I'm just kidding.
That's not funny.
I know. Sorry about that. The real question is, which I think is a good one, you mentioned it earlier, that the rescue part of the name of the presentation, retirement rescue. So this question comes in from someone who asks, in your opinion, what is the most important first step someone should take if they feel behind in their retirement planning?
So I hope that you guys appreciate some Ted Lasso. People who have not seen that, it's a very uplifting show that comes on. Don't hit the panic button. Don't hit the snooze button. When you feel the need, why would you not want to have peace of mind? Nothing. It doesn't cost you anything to have a phone call with me. And very quickly, I'll tell you if what I do isn't needed. I'm not going to try and recruit. That's a recipe for disaster for everyone. I'm not trying to recruit clients that do not need me. Um, that's the most important thing that I can do is provide motivation, clarity of purpose, confidence, and experience from planning to let you know where you are and why you are where you are, and what do we either need to do to fix it, or maybe we don't need to do anything at all. So I think having that clarity of purpose and if you feel that fear, then you should call. That's pretty simple. That's the most important first step.
Understood. So you actually answered that question in record time. So we have one for a bonus question for you. Is there a time when a person's age and value in their IRA does not make sense for a Roth conversion?
Oh yeah, absolutely. Yeah, we've talked with a lot of people where it obviously the amount of years unfortunately we don't live forever. If you're in your mid to late 70s, and your income is kind of borderline, that you would first off, you'd have to have 20 years left, I'd hope, or 15. But you, for whatever reason, knew that you were going to have a massive income hit in your late 80s or 90s. There might be a reason for that. But quite often, because of delays in going ahead and doing it, because of how much the tax savings really will be later in retirement from your income, there are a lot of reasons that Roth conversions ultimately do not make sense. I would say that quite often, if you're already in retirement, from our experience and what we deal with down here, and you're well into retirement, it would have to be a unique situation. So yes, often don't.
Fantastic.
Okay.
Thank you, sir. So everyone, thank you again for spending some time with us this afternoon. Want to be respectful of everyone's time, so we're going to end the webinar here. But like I mentioned, if you have any additional questions, feel free to reach out to your Diversified advisor, or if not, Christian himself with his information here on the screen. So thank you once again. Enjoy the holiday season and take care.